You know, for half a century, VIP Industries was the name in luggage here in India. But by early 2026, everything changed. The company hit a wall, a major crossroads, forcing them into a massive strategic reboot, and this time under the control of a private equity firm.
Now, in investor speak, this is what we call a classic turnaround play. You're betting on a big comeback, right? But here's the catch, and it's a big one. There's a real risk it becomes a value trap. That's when a stock looks like a bargain, but it's cheap for a reason, and it just keeps struggling, trapping your money.
So you have to ask, right? How does a market leader, a household name, get to the point where they need this kind of drastic overhaul? Let's dig into what exactly went wrong over the past couple of years.
For decades, VIP's ace in the hole, their big advantage, was this enormous network of 13,000 physical stores. I mean, they were everywhere. But then, as we all know, the world moved online. And just like that physical advantage, it just evaporated. All of a sudden, their brick-and-mortar presence wasn't the fortress it used to be. And you had these quicker, more agile competitors like Safari Industries just swooping in and grabbing market share.
And wow, you can see the financial damage right here. Look at this. Their core profitability, what we call the EBITDA margin, it just fell off a cliff. We're talking from a healthy 20% plus all the way down to just 12. They got stuck in the past, pushing these old-school soft luggage models and desperately trying to chase sales with heavy discounts. It was a race to the bottom, and it absolutely crushed their profits.
Okay, so to stop the bleeding, the management had to take some really tough medicine. They conducted this massive inventory cleanup, liquidating a staggering 220 crore rupees worth of old, slow-moving stock. Now, that's a huge financial hit to take in the short run for sure, but is absolutely critical. They had to clear the decks, get rid of the old stuff, and make room for what was coming next.
And that cleanup, it basically set the stage for the real game changer. A major turning point was on the horizon. The arrival of a brand new controlling stakeholder, and that was the real catalyst for change.
And here it is. This is the big moment. In late 2025, Multiple's private equity comes into the picture. They acquire a 32% stake for a cool 3,200 crore rupees. But listen, this was so much more than just a cash injection. This signaled a fundamental shift in how the company was run. For the first time ever, it wasn't a promoter-led, family-run business anymore. It was now in the hands of professional management whose job was, simply, to turn things around.
So the new leadership comes in with a brand new, crystal-clear mandate. Profitability first. That's it. The days of just chasing volume and slapping discounts on everything, gone. The new CEO, Atul Jain, had one primary mission: get those profit margins back into healthy double-digit territory. And the way to do that was through discipline and operational efficiency.
All right, so that's the goal. But how are they actually going to pull it off? Well, the new game plan is called Project Crown, and it's basically a three-pillar strategy designed to rebuild the company from the ground up.
So, Project Crown is the new playbook, and it rests on three core pillars. Pillar 1, achieving dominance in hard luggage. Pillar 2, a serious push towards premiumization, making the brand feel more high-end. And Pillar 3, cleaning up what they call channel hygiene.
And we're already seeing the strategy in action. The company has made a massive pivot into, well, hard luggage. These modern, more durable suitcases now account for over 60% of their entire product lineup. And this isn't just about chasing a trend, it's smart business. Hard luggage generally carries better profit margins, and it's exactly what today's travelers are looking for.
And that third pillar, channel hygiene, it's all about cleaning up how they sell their products. In simple terms, they're hitting the brakes on all those heavy, constant e-commerce discounts. Look, those sales might give you a quick boost in volume, but they were absolutely wrecking the brand's equity and killing profitability. The whole point here is to rebuild the brand's value, to make people feel that VIP is a premium product that's worth the price.
Okay, so we've laid out the problem and we've looked at the proposed solution. Now it's time to weigh the two sides of the coin, the bull versus the bear case for VIP's future.
So let's start with the optimists, the bull case. The bulls are betting on a sharp V-shaped recovery. That means they think the company will bounce back really fast from its recent lows. The thinking is pretty simple. With professional management at the helm and all that old, costly inventory gone, VIP has a clear path to get its EBITDA margin back to that historical sweet spot of 15% by FY27.
And a huge piece of that bullish puzzle is cost savings. By expanding their manufacturing capacity in Bangladesh, they're projecting a drop in logistics costs by about 150 to 200 basis points. Now that translates to about 1.5% to 2%. It might not sound like a game changer, but when you're talking about millions of units, those savings become massive. And of course, they have the war chest from multiples PE to make these kinds of efficiency moves happen.
But, of course, there's another side to this story, the bear case. The pessimists are looking at some pretty serious challenges. For one, VIP is saddled with a substantial debt load. We're talking around 750 crore rupees. And on top of that, the competition is absolutely brutal. Right now, their rival Safari is leading the pack in profitability. There's just no guarantee that VIP's big push into the premium segment will actually work, especially in such a crowded marketplace.
So where does the research report land on all this? What's the verdict? Well, it frames this as a tactical opportunity. This isn't necessarily a buy and hold forever situation. The recommendation from the report is to buy on dips, which basically means looking for opportunities when the stock price takes a temporary hit. It's a play for investors with a 2 to 3 year horizon. But, and this is a big but, the report also makes it clear that the market is already pricing in a lot of this potential turnaround success.
So really, it all comes down to this one central question. Can this new leadership team actually execute on their Project Crown strategy and bring VIP back to its historical 15% margin profile? Or is this whole thing going to fizzle out and become that classic cautionary tale we talked about, a value trap? I guess we'll find out. The next couple of years are going to be critical.